All right, guys, welcome back. So, I'm going to go over today's daily market review, and I wanted to talk a little bit more about auction market theory because I feel like the last video that I had recorded was a little bit convoluted, and I just wanted to, kind of put this topic into layman's terms, something very simple for you guys to understand. So, this is pretty much the premise behind how every market operates. So, what is an auction market? So, an auction market, we need a buyer and a seller, and between those buyers and sellers is going to cause some type of imbalance. So, the market is always going to seek balance and is always going to try and discover what is premium and what is discount. So, if I flip over to this, this was probably the simplest example that I had found. So, where does auction market theory come into play? So, in a market, we're really only going to have three types of market conditions or prices for a specific market. They're either going to be at a premium, a discount, or somewhere at fair value, which is in between a specific range. So, when these markets go into consolidations and markup and markdown periods, we can find the narrative behind what these market participants doing and who is operating in the market, who's trapped, and who is I guess where the smart money is operating. Right? So in a consolidation, typically markets are trading at fair value. So there is some type of balance between buyers and sellers. And then we have some type of market event which will either drive the market up or down, which creates an imbalance, right? An imbalance of supply or demand. Now, I don't really teach supply and demand, but the markets operate in a specific manner that books price, and it understands that there's going to be certain buyers at discount levels and sellers at premium levels. And the market algorithm just drives to those levels to facilitate trade. So the discovery comes into play when it's searching for new buyers or sellers at specific levels. All right. So for every buyer, there must be a seller. But the market is going to reprice to either a premium, a discount, or fair value. All right. So we have this example with the car market, right? So we have fair value, some type of market event that is driving it up, driving the price up of this car. Let's say if this car was bought in the past, there might be an imbalance of demand versus supply, which will drive the market higher, right? If we run out of willing buyers at a certain price, there's going to be more sellers that come into a market, okay? And if they have too much of a specific asset at one price and not enough willing buyers, the market has to reprice to fair value. Okay? So let's hop over to the S&P, and hopefully I can make this as simple as possible and kind of help you guys visualize, on a chart, this whole theory in action. All right, so if you've been following me, I've been looking for higher prices in the S&P. And I had mentioned that last week when the market was trading up here, right? We could possibly rebalance to a discount before going higher. So now this week, on Monday, I had messaged some close people in my group that this looks interesting, right? So when we took out last Tuesday's high, I said this level is now interesting. Why was I interested in this level specifically? Well, I'm going to try and get you to help visualize this. So let's just say that this market participant in here, again, his name is Chad. Right? So, and if Chad expects the market to go lower, right? If he's expecting that the recession narrative behind what's driven by the media, that this market is going to top and we're going to seek all-time lows, or not all-time lows, but new lows on the year, right? That's Chad. The media narrative is driving his position in the marketplace. So if he is taking a bet against the marketplace, he's going to set a sell order in here to short the market. And in order to protect his capital, he has to set a buy stop order and a buy limit order at some point lower in price. All right, so let's put in his short position here. Let's say he just shorted it here. His protective stop is up here. And let's say his target was new yearly lows. Let's just say, so this was the beginning of 2023. Let's just say that he wanted to short the market and he's expecting that the market is going to trade to new yearly lows, right? So we have his entry here. His entry is at this price. Let's say he entered at right around 4,008. The stop is about 4,050. Let's just call it. So he has to set a buy stop order. All right, so if he's short, he will buy his position back at a loss. And if it reaches target, it's a buy limit because he has to buy it back for a profit. All right, so when he enters this position, he's creating 2 additional orders in the marketplace. Okay, so these are Chad's. When he enters it back here, right? If he enters it here, this is what his position looks like. He's entering as short. He's setting his buy stop, protective stop, and then a buy limit for his target. All right, so when we fast forward to where we are right now, currently, what is this signaling up here? Right? If my premise is overall bullish on the S&P, what is this narrative and why do we see a deep retracement and a huge rally today? Well, once the market trades up here, right? Assume that Chad is not the only one shorting it. Say there's 9 other traders that shorted the market, right? And let's say there's only 20 participants in the market overall, right? So 10 of them are short, right? So their buy stop is here. But let's say that the market trades up there. And now there's less buy orders. Let's say there's some buy orders up here, right? But not enough for the market to facilitate up there because it's already at a steep premium, right? Let's say if it goes up there and now the order book is dried up. There's not enough buy orders up here to facilitate, and there's not enough willing buyers for it to go up there. All right, so once the market trades up there, Chad and his 9 other friends are willing to buy it at a loss, right? And we're expecting that the market is already at a premium where nobody is willing to buy it above old highs. Well, the market is just going to seek a rebalance. It's going to rebalance to a discount level in the market. All right, so we had this swing from this low to this high. If we drew that out, right? So this was a premium. All it did was rebalance to a discount before it was allowed to run higher to these stops. Okay, and then same thing happened here. We had a swing low to a swing high, right? The market will just trade to a discount, offer lower prices, and then send it higher. Okay, so what is happening down here, right? Chad took a short up here. When we get down into a discount, who is buying the market? Okay, so let's say that I'm going to step into the marketplace and I think that the S&P is going to go higher. Well, if I'm gonna take a bet that the market's gonna go higher, I'm gonna place a long with my exit where Chad's stop is. Right? So I'm going to move this over just a tiny bit. If I'm buying it down here, right? This is my entry. So I'm long on the market. And in order for me to set a protective position, I need to have a sell stop. And my target will be a sell limit. So how is this trade facilitated, right? I'm entering in the market. When it gets up to my sell limit, whose buy stop is resting at that level? Chad's buy stop is resting above that high. So I can sell my position to Chad. He's taking the loss on the position, and I'm taking a win. All right, so this is the auction market. My order is being paired with someone else's order at a premium level. All right, so once the market trades up there on this bar, right? Let me just go back one. Let's skip forward one bar. Once the market trades up there, this trade is facilitated, and now I'm out of the market. Right? So there might be somebody else that steps into the market where Chad took a loss on, or I could switch and reverse my position if I'm smart money. Right? I caught the long down here and I exited on Chad's buy stop. Well, now I can sell it and put a protective stop above this high because we purged the high. Right? And what am I going to look to target? If this is the swing, if this is the price swing, the parent price swing, right? It needs to trade back down to equilibrium. So if we go over to this market example, right, we have a low, we have a high, and then somewhere inside of the range, they will create a fair value between the low and the high. All right, so we have a buy imbalance and then a sell imbalance. Right? We have a buy imbalance. Skipping forward. Right? This is a buy side imbalance. They're repricing it to a specific discount level before it can go higher. So this is the low, the high, and then we'll reprice it to a fair value. And if the market is predominantly bullish, they're going to want to buy it at fair value before the market trades up above the last premium high. All right, so let's dive in and take a look at these fair value gaps and inefficiencies. Right, so I mentioned on my last video, or a couple videos ago, that inside of these imbalances, the 50% level of that imbalance is another point of equilibrium. Right? If we have a parent price swing, we have the low, the high, and then somewhere in the middle is fair value. So when we find this imbalance in the marketplace, this is a buy side imbalance, sell side inefficiency. The high of this candle and the low of this candle creates a gap in price. So ICT had mentioned this, but if you think about a paint roller, right? If we roll up the wall, just one quick pass, it's not enough to coat the whole wall, right? As an analogy, if it's just one quick pass, you're going to have white spots, whatever the drywall color is, behind the wall, right? So at times, we have to come back and give it a second coat. So what is it going to price to? It's just pricing to a level of equilibrium between the imbalance. So if I was looking at this trade and it was very similar to what I had seen last week, right? We have this buy side imbalance, and then we have the 50% range, right? So when we get deep retracements in a bullish environment, that is where smart money is looking to position themselves on the dip, right? They don't want to buy it up here because that's a low probability trade. Only people that are on the losing side of the market are buying above old highs, right? We want to buy below old lows. Okay. So if we drop down into the 5-minute today, right? I'm just looking for some reason to go long the market. So if this is the daily level on a 5-minute time frame, okay? So this premium high of this imbalance, the low, and then fair value in the middle. Right? That is the equilibrium point of the range. So when I drop down into an intraday chart, I can see these daily levels. Right? We have the premium high, the equilibrium point, and the low end of that imbalance. Right? So what did this do? What was the narrative here? Right around lunchtime, I had mentioned that the market is down a whole lot on the day. So when the market on the 9:30 bell, right, the market was already down a whole bunch. This whole candle looked extremely bearish. So when the market really opens, the futures market, the CME open, and the 9:30 equities bell, when the market is down into a discount area, what are the probabilities of it continuing lower in a bullish environment? Right? If we have targets higher up, right, 4,200 possibly, the market's had an accumulation phase, a markup, a retracement, a push higher. Right? There's no signs in the market that are currently showing us bearishness. So on a 5-minute time frame, we're just looking to get in sync and find a market structure shift. Right? So this is the auction market theory. Someone is being flushed out of the market. We had Chad's sell stops possibly. You might be shorting it. Let's say if you come into the marketplace and you see that the market's down on the opening bell, I think it was 1.5% maybe on the day, right? Who is going to continue selling it? Retail and other uninformed money is going to continue selling into the lunch hour, right? And we have a small push lower from the 9:30 open. Here's the 9:30 open. We push lower. And then right around lunchtime, the time of day, we have a market structure shift. Right? We had a swing failure and then a push higher. Right? Creating another imbalance in here. Buy side imbalance. Before pushing higher. So whoever's positioning in here is going to just look to exit at some predetermined point where there are buy stops resting, right? So if they're going to get long inside of here within a daily discount, where are they going to target? They're going to target buy stops. So we have buy stops above the marketplace that are now our next targets. All right, so this is above Monday's high, which is possibly our target for tomorrow. And then we have the 50% range of this wick, right? So this long wick has a premium and discount level inside of it. And then eventually we have the old high back here. Okay, so this whole narrative is based on buyers and sellers. Where are they returning to fair value, right? This is a fair value gap in price. And where are they going to reprice it to at a premium? So within this smaller time frame, there are additional range levels to play to. Right? So we have this low and then this high. Right? So there might be buyers down here and they're looking to offload above the highs. Right? If we go back to the auction market theory, we had fair value. Right? Fair value in here. A market event, fair value, trading between a range, market event. So we have buy side imbalance, sell side imbalance. Right? Buy imbalance, sell imbalance. Fair value. And then it's allowed to reprice higher. So putting this into context, right? We're just always trying to figure out who the participants in the marketplace are. What are they repricing to, right? Because this whole move today was just them repricing to a discount, right? They're just coming down here, tapping below equilibrium and setting it higher. Right? So this setup last week was very similar. Right? We had a run. This is the buy side imbalance to a discount. Right? We have some level of discount in here. So these are inside of here. These are the imbalances that we need to look for. Right? And then on a lower time frame, there are possibly setups in here that are respecting those levels. So what am I looking for on the S&P? We are still looking for higher prices. And now that we have this in place, right, we're expecting our next daily candle to form some type of swing point. Right, so we could possibly have the candle like this. Let me just make this white. Let's just say it opens up here. Might have some type of wick in here. Can I get this right? Oh, Jesus Christ. Oh, you get the picture. All right, we have the wick possibly down here. Why can't I get that in the middle? It's kind of annoying. All right, well, I mean, we'll have a possible swing point in the market, so this will become our invalidation. So until this low is broken, right, we're just looking for higher prices. Now I'm going to flip over into the cable and kind of give you guys the rundown on what I was looking for on the daily chart. So we have this sell side imbalance. Right, we've traded above it, and we've engineered liquidity above the highs. So when the market first traded up there, let's say Chad was back here, right? Right, and let's say he's got a short bias on the market, right? When the market trades up here, let's say Chad tells his friend, or maybe, somebody at the dinner table, hey, you should get short the market or short the pound. I think it's going to keep trading lower, right? So let's say he told his friend, Lisa, and now she's short the market, right? Now they have their stop losses above both of those highs. So what the market is going to do is just reprice it to a discount before they send it higher. So if we measure this using a Fibonacci, right, this is all it's doing. Yesterday, the market was extremely bearish, but it's only doing that to return to a discount. Right, so your narrative of the market is going to keep you on the right side. You might have losses here and there, but the important thing is to create a bias, generate a bias, and stick to it. Right? The market's trading down. What is it trading to? We have this buy side imbalance in here. All right. And so the market is trading higher, right? It's just trading to a premium, returning to a discount. And then we have a market structure shift. This is a short-term swing low. So the market is just returning to a discount. And then we have, even on a smaller time frame, we have this impulse swing, return to a discount, and then higher. All right, so the direction is bullish on the pound until further notice. So we have these highs, which will possibly get targeted tomorrow. And then we possibly have this inefficiency up to this candle's low. And we possibly have the liquidity above the high back here, which is May of last year. All right, so let's go over to the dollar and take a look at what I'm seeing right now. So the daily, I'm still targeting down here. I think tomorrow we possibly have a large expansion candle to get down there, below this low at least, and then down in here. So during New York, this is what I was looking at. Let's remove this. Let's see. Turn off the sessions. All right, so the euro and the pound are highly correlated with the US dollar. The euro more so than the pound, but so are all other risk assets. So when I came to the marketplace this morning, this was the fair value gap that I was looking for. So the narrative behind this is pretty much the same thing. We have a premium high, a discount low, and then a return to fair value. Right? So just pretty much inverse this. We have a sell side imbalance, return to fair value before driving it lower. So we've barely taken Monday's low. I'm expecting possibly for the market to trade up into here tomorrow, and then on a daily basis, try and target the 101. All right, so I hope you guys found this useful. If you have any questions, just leave them on the comment section or drop me a message. Thanks.